It's July 2nd. Perry portfolio remains defensive. It is structured for a forecast of stagflation, which is slow growth, and inflation that is rising faster than growth. That's stagflation. GDP, according to the latest figures, came out today from the Atlanta Fed, just under 2%. That's nominal. Just looking at inflation, to take the most logical headline figure, CPI, consumer price inflation, is rising at 3.3%. So when the economy is inflating higher than the growth rate of the economy, that's a stagflating economy. When wage inflation is rising faster than inflation itself, that's a structural systemic inflationary pressure that's in the marketplace. So anyway, because of that, higher inflation and lower growth, I think that the first thing to think about is you probably don't want to own bonds. I'm talking about treasury bonds and anything with the duration, beyond a T-bill, 2 years, 5 years, 7 years, 10, 30-year bonds. The risk to interest rates is that they go higher because inflation is going higher. And the fact is, even though the Fed hasn't moved in almost a year now, right? The last Fed hike was July 20th of 2023. And here it is July 2nd in 2024. And the fact is, in the last year, because everybody was thinking that rates were so restrictive, stock market surely must have gone down, right? But if you look over the last year, stock market's up 20% in the last 12 months with a Fed funds rate that, according to Mr. Powell, is restrictive. And if it would be restrictive, the stock market would be down 20%. So nobody buys that. And he obviously doesn't talk to his colleagues at the Chicago Fed, who've been saying that monetary policy, along with fiscal policy, is the most stimulative it's been in 20 years. So anyway, interest rates probably going up. Would have thought they went up higher first. Maybe that's because the government's buying so many of them and shifting their maturities of their ownership lower. Hard to say. But the fact is that underweight long duration bonds. And as a really good proxy, you can still get 5.35% in a T-bill with no duration risk, right? So the bonds always mature at par, so you're not going to get a principal hit. So on a risk-reward basis, a T-bill is still the best thing that investors can do. And frankly, people buy bonds, pensions and insurance companies buy bonds really just to mash cash flows. They're not doing it for capital gains. And hedge funds, I wouldn't believe that a hedge fund was thinking that at the 430, 440 10-year note, that you're going to get a move to 100 basis points lower than that at a time when the budget deficit's $2 trillion and national debt's almost 35. So to me, on a risk-reward basis, you don't need bonds. Stocks like it because really, again, liquidity is restrictive. It's not the whole stock market, though. In fact, I just saw some information today that said in Q2, two stocks, NVIDIA and Apple, are responsible for 3/4 of the gain in the S&P 500 in 3 months. That's extraordinary. It might be validated, but the fact is that means that the other 498 stocks in the S&P 500 were responsible for a quarter of the S&P's returns this year, and that means we're up 15%. So 3/4 of the stock gave 2.5%, 3% return. That's not much. So you don't want to be there. You want to be on what's moving. The Industrial Revolution, which is AI, that's where the money's being spent by private investors, by corporations and the government. So I think if you're going to be long, you want to be long the companies that will support the continued build out of the Industrial Revolution. I also bought a little stock about 2 weeks ago now. Nano nuclear energy. It seems like a really good idea. It seems like we're going to be short on energy in 3 to 5 years. And if they don't start building these things, the Industrial Revolution, which is AI, will stall. So it's a priority for the government. It's a priority for corporations to build out the smaller, safer nuclear reactors. Okay? So that's the portfolio, and we'll go into the reasons why it's that way in the next scene. Okay? Thank you.